Welcome to the Capital News. I am your host, Alex Karitis. Thanks for joining me, everybody, on this 15th day of February 2019. Let's get straight into the economic and investment news of the day. Well, stock market wasn't a roller coaster whipsaw ride today. It was an elevator straight up to the top floor. My goodness. The S&P was up 29 plus points, or 1% for the day. The Dow closed up 444 points, or 1.75% for the day. The NASDAQ was up 45 points, or 0.61%. The Russell 2000, the small cap index, was up 24 points, or 1.5%. And oil even made a nice little rally today, up 2.5%. Gold and silver were also up. Gold up 11 points, and silver up 23 cents. So a nice little comeback for the precious metals on a day that was really a risk-on day. So to see gold make the kind of comeback that it did today, is this part of the decoupling that I've been talking about, where you're going to start seeing risk assets go up, gold go up, which is typically a safe haven bet, or maybe it's an insurance policy on inflation to maintain one's purchasing power, because gold is a very good store of value. Who knows? We're in the land of Oz. Everything could go up and make new highs. It could collapse. It's day to day. What's the headline? 10-year Treasury yield was up, 2.67% yield. So there was some selling in the bond market, which of course makes sense if you have a better appetite for that risk-on trade into the stock market. So that's not surprising. And then, depending on the currency, the dollar was mixed. A little stronger against the euro, a little weaker against the pound. And last Friday, I said that that was the 7th straight week of market gains. Well, here we are this Friday, and now we have the 8th straight week of market gains. That's incredible. 2 months. This, at this point, is undoubtedly a V-shaped recovery. How much longer it lasts is really anybody's guess, because this is completely headline-driven. As I had stated in the other podcast today, in episode 10A, President Trump gave his speech in the Rose Garden following his declaration of a national emergency, and he was questioned by the press corps about the debt and the economy and whatever, and he took it down that road on the economy and the stock market, and saying that the economy is strong, it's never been stronger, it's the best in the world. You know his spiel. And that the economy is going to continue to make new records, new highs. That the stock market is going to make new records, new highs. We got them all. He wants to hang his hat on this economy and stock market. I can understand to a degree the economy, although I would be weary. I would advise him differently. I would definitely not hang my presidency, any part of it, on the stock market. It's really at complete odds with what the president said when he was candidate Trump, saying that the stock market's a bubble, it's being fixed, it's rigged. It's being rigged by the Federal Reserve. It's all funny money. It makes people like himself and other very wealthy individuals that much more wealthier. I talk about this all the time. So why he wants to hang his hat now on the Federal Reserve and on the stock market is anybody's guess. Because as candidate Trump, I mean, as far as I was concerned, he was preaching to the choir. He was saying all the right things. Like, finally, somebody is having a conversation about this stuff. And despite the man being in the real estate market, meaning he really likes low interest rates to fund all of his construction projects, he gets it. He understands it. He knows that the Federal Reserve is at the core of this problem. He understands that there's some funny business going on with how government statistics are calculated, and that the fact that they're always changed and updated. Well, how do you think they're going to be updated? To help or hurt the government's argument? It's always going to make things look better. It's going to make inflation look lower. It's going to make employment look better. It's going to make GDP look better. All these things. Any which way it can go to help the government look better is the way these statistics get recalculated. And believe me, this is what I went to school for. You cannot replicate some past studies depending on the government-supplied statistic because they have been changed so many times in how they are calculated. And believe you me, it's not for the betterment of the people, it's for the betterment of the government. So they have a better story to give to all of us so we can sleep well at night. Now, of course, another thing that the president brought up during his Q&A with the press corps in the Rose Garden was, in fact, the talks with China. What's going on there? Well, of course, everything's fine. It's great. He expects to meet with President Xi in the not-too-distant future. Again, there's soon. When is soon going to happen? I imagine it will. Will it be the best deal ever? Probably not, but we'll be told it's the best deal ever. Or it'll be jockeying for position between that being the best deal or the USMCA between the United States, Canada, and Mexico. Maybe it'll be a tie. I don't know. I don't think that ties exist in the world of Trump. Somebody always has to be a winner. So which trade deal is going to be better, I don't know. He might have a hard time saying which one's the best. But don't you worry, stay tuned. He will tell us. Now, it's interesting because I'm on the East Coast of the U.S. I'm more of a night owl. And so I was watching some of the markets around the world. I was watching some of the Asian markets, some of the early trading hours of the European markets. And it was interesting because I'm sitting there and I'm happen to be watching Bloomberg markets. And you have these Asian markets that are selling off 1% and 2%. You have the Nikkei, which is the Japanese market, down 1%. You have the Hang Seng, the Chinese Hong Kong markets, down 2%. And I'm like, what is going on here? Because the U.S. just had a tepid day yesterday. We had that report, the retail report out. And there really wasn't that much negativity to it. But of course we had, Larry Kudlow come out and say we got good vibes, real good vibes here with the U.S.-China trade talks. And that, of course, lifted the market back up. Any hint of anything with the U.S.-China trade talks, and it's like catnip to the stock markets that just goes haywire to the moon. So I'm sitting there and I'm watching Bloomberg, and the Asian markets are going down, and the futures for the European Open are all down. The U.S. market futures are all down. And I'm thinking here, what's the news? Nobody's really talking about it, and you see some things come across the screen, and then some of the newscasters start talking about it. And it's the U.S. retail sales report that came out and was much worse than expected. It had a devastating effect on the Asian markets, had a almost non-existent effect on the U.S. markets, especially after the good vibes statement by Larry Kudlow. I mean, 1% is a big move. 2% in a day is a huge move. Those aren't standard. Even the run-up that we had today in the U.S. markets. That's why I gave the percentage moves. Because anytime it is 1% or more on a day, that is abnormal. That is a very strong day, whether it be to the plus side or whether it be to the negative side. Obviously, that's a weak day. But it's a big move. It's a big swing. Something had to take place. So when I woke up this morning and I see the markets in the U.S., I'm expecting them to be down. They weren't. They were going straight to the top floor, straight to the penthouse. Why? Well, you guessed it. There was more talk about U.S.-China trade. President Xi came out and told Chinese papers that he is going to send the trade delegation back to Washington, D.C. next week to continue the trade talks. And Secretary of the Treasury, Steve Mnuchin, basically echoed that sentiment. Things are going fine. The talks are open. We're continuing dialogue. You're supposed to be continuing dialogue. You're in trade negotiations. You're supposed to be going back and forth. That's clearly the deal. We go to China, the Chinese come here, we go back, they come back. Until a deal is struck. Or a deal is not struck. But we have a deadline of March 1st. But that might be extended. Might be extended 60 days. The president doesn't want to do it, but he will. There's still no concrete answer on that. So stay tuned for that update, if and when it comes. This is just more nonsense to me. You can feel free to disagree and let me know. But you're in a trade negotiation, which means you're supposed to be negotiating, which means you're supposed to be meeting each other and having discussions. So when both sides come out and say, we're having negotiations and we're talking, that's what you're supposed to be doing. But then the markets rally on this news. To me, that's akin to saying you showed up to work to do your job, and just because you showed up, you get a raise. Or am I crazy here? It's just a complete disconnect from reality. We have a terrible retail sales report. On the back of a terrible report from the New York Federal Reserve, 7 million Americans 90 days plus past due on their auto loans. We have retail store after retail store declaring bankruptcy. Brick and mortar retail saying, we're giving low and poor guidance here for 2019. The list continues, and we're told this is the greatest economy ever, mind you. And the markets are up 1 to almost 2% in the U.S. It just boggles my mind. It boggles my mind. And a lot of this is on low volume. It continues to be on low volume. Now, for those of you who watch the markets a little more closely and are more familiar with some technical jargon, especially if you watch the charts, these markets are coming very close to their 200-day moving average. So it's going to be interesting to see if these markets break through that 200-day moving average, and will the 200-day moving average act as resistance and then potentially become support if we do break above it for a while, and then we very well may make new highs. That's what President Trump is calling for. Remember, I think it was December 24th, Christmas, the day after? He tweeted, buy the dips. The market rallied 1,000 points that day. He sent Secretary Mnuchin to the plunge protection team, the largest banks in the U.S. What they said, I have no idea, but we can look to see what happened after the fact. These markets have rallied for 8 straight weeks. Buy the dips. And we have had a V-shaped recovery since in these stock markets. Is this market manipulation? What's going on here? Because it's low volume. Who's buying? Who's coming in at the end of the day and just pushing these markets up, up, and away? Where's the fundamental news? We have fundamental news. I just gave it to you. Poor retail sales. A consumer that can't pay his auto loans. What's next to drop? Something is amiss. This isn't right. I don't like any president coming in and saying buy the dips. Where was he in October and at the top of December saying sell short or get into cash because you're going to lose 20%? Did he prepare you for a 20% decline? No. So why is he coming in and telling you to buy the dips? If I was the president, I would be very careful. These House Democrats are in charge. They want to investigate him for everything under the sun. Why do you want to get them involved potentially, in looking into what's going on in the stock market, with what you tweet, what you say, how you sent Secretary Mnuchin to meet with the plunge protection team. And since then, there's been a V-shaped recovery in the stock market. Something's amiss. I'm no detective. I'm no Sherlock Holmes, but I mean, that was pretty easy to make. That was not a hard connection to make. I'd much rather the president and the Federal Reserve get out of it, but I just don't think that's going to be the case. Now, into some other news. I'm going to continue with our list of 30 market risks for 2019, which was comprised by Deutsche Bank out of Germany. We got through the first 12 of these bullet points, so we're on point number 13. Number 13 and 14 are pretty much the same thing. They read the following. No deal Brexit in March could be negative for markets. And point 14 reads, no deal Brexit in March could be negative for UK economy and hence also the European economy. Well, we know this is going to be the case. We already know that Europe is suffering. We know that Italy is in a technical recession. We know that Germany, by the skin of their teeth, avoided a technical recession. They very well may be in a technical recession, but then you might have some messing around there, some fudging around there with the German economic numbers. The government might have tweaked something just to make it look a little bit better for them. As to not to cause panic, of course. Let's not tell the people the truth, but we'll give them the benefit of the doubt. We'll say that number's true. And by the skin of their teeth, they avoided a technical recession. Let me read an article to you. I'll read just a couple paragraphs. This is in regards to Brexit. This is from Vox. Brexit chaos. Theresa May loses yet another Brexit vote. British Prime Minister Theresa May asked Parliament earlier this week to give her a little more time to renegotiate part of the unpopular Brexit deal with the European Union. Parliament just responded with a resounding nope, voting down the motion 303 to 258 and leaving the Brexit impasse as intractable as ever. May's defeat was mostly symbolic and doesn't change anything practically, but her loss was still remarkable and yet somehow not all that surprising given the complete and utter shambles that the Brexit debate is in. Most critically for the Prime Minister, the vote undercuts her pitch to the European Union that if it offers concessions on the Brexit deal, specifically renegotiating the so-called Irish backstop, she'll finally be able to rally enough support in Parliament to get a Brexit agreement passed. But the defeat of her government's motion, led by pro-Brexit members of her own Conservative Party, no less made it clear that May is still struggling to get her party to back a Brexit deal, and likely won't be able to even if the EU were to offer some concessions. So the UK Prime Minister Theresa May is still scrambling here. And while the US-China trade deadline, at least the first trade deadline, is for March 1st, the deadline for Theresa May and her government is March 29th, and then we'll see what happens there. Are they going to strike a deal? Will Parliament agree to a deal? Or will it be a no-deal Brexit? Which is exactly what it sounds like. They don't make a deal, yet Brexit still takes place on March 29th. What happens? It's anybody's guess. That's why those are 2 bullet points on this list. Who will honor a customs union, the free movement of people? Will there be a bottleneck of goods and services at the border and ports of entry? A lot of questions that remain unanswered. And will continue that way until a deal is struck. Point number 15. U.S.-China trade war escalates further. Well, we're told everything's good, everybody's got good vibes, there's nothing to worry about. Chinese are coming here, we go to China. They come back, we go back. So the trade war escalating further, I guess, is a possibility. But at this point, we're told everything's fabulous. So there's nothing to worry there. Point number 16, U.S.-Europe trade war escalates further. Of course, this gets a lot less press coverage in the news. But this is something that is still ongoing. There are still tariffs involved, and President Trump loves tariffs. That's what he said in the Rose Garden earlier today. He loves tariffs. We're getting in billions and billions and billions of dollars into our treasury. And of course, he says it's coming from China. Of course, that's not true. You pay your taxes, you're paying the tariff. A tariff is a tax on trade. Simple. End of story. China is not writing a check to the U.S. Treasury of billions and billions of dollars. Just not the case. You're paying for it. Or maybe that some of the companies who are importing it into the U.S. are paying some of it and eating some of that cost. Maybe they're not passing all of it on to the consumer. So it's either a U.S. company or it's the U.S. consumer that's paying this tax. It's not the Chinese sending in all these billions of dollars. And of course, higher cost to the consumer is not a good thing for this economy that is just supposedly, according to the president and his advisors, on fire. So you can't have it every which way you want it. Point number 17, the Fed decides to ignore accelerating wage growth. This could threaten profit margins. Now, I don't know what the Fed's going to do. I mean, what are they saying here? We have wage growth, which we do. Of course, it's not outstripping the real cost of living, so net, it's not a true benefit to the people, especially the middle and lower income classes. But nevertheless, there are increases to wages. So what's this point saying? If the Fed decides to ignore accelerating wage growth, what are they supposed to do? Stop it? You're finally getting a pay increase. Oh, we got to cut that you-know-what out right now. Not going to have that. This could threaten profit margins. Now, I've been talking about this a little bit. You have all this funny money, you have all this liquidity making its way throughout the economy, and has been for the past decade. What is eventually going to happen? It's going to catch up with itself. Because a lot of this is debt. And what is debt? It's future consumption pulled forward to today. So you get to reap the benefits of that growth today at the expense of the future, because you're going to have to pay that debt off. Okay? Very simple to understand. So if you have increased wages, and if you have increased debt costs that need to be paid off, well, that most definitely is going to threaten profit margins. That's why you're starting to see a whole bunch of layoffs take place. That's why you're seeing a whole bunch of retail, especially brick and mortar retail, shutter, close the doors, bankrupt, gone, see you later. Because you have wages going up, and you have the cost of your debt going up. Not to mention astronomical amounts of debt to begin with. Now, wages are one of the most expensive costs on any company's income statement. So how do you eliminate or reduce it? Well, you lay people off. And that's what you're starting to see. Layoffs in banks, layoffs at GM, General Motors, retail, across many, many, many sectors. And in my opinion, it will continue because this debt is getting unmanageable for a lot of these companies. So what you're going to continue to see is a profit squeeze. It's going to threaten these profit margins. And then you're going to see lower earnings, because all of these earnings that the companies are making have to go to pay off this debt. And if earnings are the mother's milk to stock prices, well, what do you think is going to happen to stock prices? They're going to fall. By how much and when is the question. Point number 18. Fed decides to ignore accelerating wage growth, and this could unanchor inflation expectations. So there could be a surprise inflation number. The Fed stops their rate hikes. And then, boom, one report we have out, inflation is above 2%, and seriously above 2%, maybe 2.3, 2.4, 2.5%. The Federal Reserve, they might be okay with 2.1, 2.2. They'll say that's quote-unquote symmetrical around our inflation target of 2%. So if inflation is at 1.8, 1.9, they basically consider that 2%. If it's at 2.1, 2.2, they'll basically consider that 2%. And it's symmetrical around 2%. Make sense? If it goes above that, so you're talking 2.3, 2.4, definitely 2.5, and you have that surprise shock reading, now what's the Federal Reserve going to do? Because they're supposed to keep inflation in check. Does that mean that they are going to increase interest rates now to get inflation in check? Do they want to risk another report and it be even higher, and then there's no question that they have to raise interest rates? Or they've boxed themselves in to make it seem like they have to? So that's a legitimate point on this list. And then lastly for today, point number 19, escalation of yellow vest protests in France. If the protests continue this weekend, I believe that will be the 14th straight weekend of yellow vest protests taking place in France. What is taking place? People are upset with the cost of living. People are upset with the socialist government that they voted for. They're finally running out of everybody else's money, and now they're scratching their heads and saying something ain't right here. And they're blaming the government for not making good on all of those ridiculous promises. Well, here we go. Take a look, Democrats and liberals, take a look, Alexandria Ocasio-Cortez, take a look, Kamala Harris, take a look, Cory Booker, take a look, Pocahontas. It doesn't work. Okay? If you think that's such a great thing, then you go live over there. Go run to be their president. Go run to be their prime minister. It's not welcome in this country. It's not American. All right, everybody, have a nice, long President weekend. Please share, like, subscribe to the channel. And again, enjoy this nice, long weekend. I hope it's a nice weekend. Hopefully it's not too cold if you're on the East Coast. Get some sunshine. This is the Capital News. I am Alex Karitis. Godspeed.